Hi, welcome back to Flipping Heck Business. This is the second video in our AQA A-Level Business Studies series. So my name's Dave and I'm an A-Level Business Studies teacher, and I've been creating these videos for my class but also for anyone who wants to use them. Please make sure to hit that like and subscribe button and turn on your notifications in order to keep up to date with each video as it comes out. So this video, we're still on 3.1, so what is a business? And we're going to be covering different forms of business. Now that includes incorporated, unincorporated, limited versus unlimited liability, private and public sector, and public limited companies as well. When it comes to revision, then business forms links to share and shareholders, organizational structure, business objectives, and stakeholders. Now this is really useful information, so you can use this further down the line when it comes to detailed analysis work, where you'll be expected to bring in other areas of the curriculum, not just the one that we're looking at now. So when we're looking at different types of business, then there are actually three main types that we look at. There's the non-profit sector. So these are things like charities, cooperatives. So you've got Red Cross, you've got the Co-op, John Lewis. We also look at public sector. So this is like anything to do with the government. So you're looking at police, NHS, any kind of like school. And then we've also got private sector. Now, this is kind of the main one that we actually concentrate on. And private sector is your proper shops that you see out there, such as your, JD's, McDonald's, etc., etc. Now, there are actually two ways that we can split the private sector, which is into incorporated and unincorporated. So unincorporated can then be further split into things like sole traders or partnerships, which we're going to talk about in a bit. And incorporated becomes private limited companies or public limited companies. So unincorporated companies are companies which basically they have a legal responsibility for the company. The owner themselves still has complete legal ties in with the company. They're considered the same entity. So for example, if there is any kind of debt, then the owner could potentially lose some of their belongings or their house to help pay off that debt. This is what we call unlimited liability, which again we'll cover in a couple of slides, and it's usually sole traders and partnerships which are actually unincorporated. Now incorporated is the opposite. So owners and businesses are considered separate from each other. They are actually legally separate entities. They are their own devices, if you like. So legal differences between owner and business, and then there is what we call limited liability, which means that if something did go wrong, the owners aren't necessarily going to actually lose any of their property or any of their goods or any of their assets. And these are usually private limited companies or like public limited companies themselves. So when we're talking about unlimited liability, now this is actually a very important definition. You really do need to understand that what limited liability and unlimited liability mean. So unlimited is unincorporated businesses, right? That's fine, we've talked about that. So the owners are personally responsible for all actions of their business. So that includes all debts, all liabilities, everything. If the business fails, then the owners are responsible for paying off all the debt and they can have their own assets removed. So this may seem like actually the most risky, but it's also kind of the easiest to set up. And most businesses are actually sole traders and have unlimited liability going on with their business as well. So the sole trader and partnerships, again, they are unincorporated businesses, so no distinction between the business and its owner. Now, they are very easy to set up. It's actually not difficult. I myself have run a couple of different businesses, any kind of restaurants. It's so simple that you can actually just fill out a few forms and it's there. It's done for you. All right. If you are actually forming a partnership, then that can be a partnership between 2 and 20 people. And all of them can have their own stake in the company, but you do need to fill out a few more forms just to make sure that everybody's accountable for their section of the business. And again, it comes back to unlimited liability. So they have unlimited powers. They have to make sure that they are actually paying for everything. And examples of this is any kind of small shops, any kind of restaurants, any kind of like individual plumbers or electricians. Now, there are a few benefits and drawbacks. Advantages, like we said, easy to set up, very few legal formalities. And, of course, as the owner, you get all the profit. You get everything, right? It's also financially privacy. Now, what it means is that you don't need to actually publish loads of your financial reports, which you do if you actually like become one of the bigger companies. And also your independence. So you may be a bit more responsive to change because you're the one in charge. It's your business. No one can tell you what to do. You don't need to try and satisfy any kind of board of directors or shareholders. But there are disadvantages. Of course, that unlimited liability sneaking up there. So personal assets can be repossessed in failure. If you want to lose your house, then this is the way to do it. May have a limited access to capital and loans. Now, capital is like another way that we actually say money or like investment. So it could limit you because, you know, if you've got a business that needs £100,000, unless you've got £100,000 in your skyrocket, then you are going to actually struggle to find it. You need to try and get those loans. But if there's like, say, you know, able to sell shares, you might be able to raise that capital. You may have limited skills as well. So, you know, if you are a fantastic plumber, it doesn't mean that you can necessarily run a business. And you just trying to do everything on your own could lead to trouble. And also, of course, if there's any kind of like holidays or if you become ill, well, if you're not actually here and like doing the work, then you're not going to be able to get any money coming back in. There's no like extra sort of recompense for like people being away or like, you know, the government are going to step in and help you if you fall sick. You are your business. And you can also end up paying a higher tax rate. So the importance of limited liability. So again, it's very important protection for your shareholders, right? If you've got a company that has 300 shareholders and it goes under, well, all of a sudden that's not going to be 300 houses that are coming repossessed. Or if you look at like companies like Amazon or Apple, where they have hundreds of thousands, millions even of shareholders, well, those people should not actually be responsible for all of the debt that has been occurred through the company. So that's where limited liability comes in. It will mean that only the value of the money you have invested can be lost. So if you've invested 100,000 into a company and it goes bust, you've lost 100,000, I'm afraid. But if you've only like invested 10 or 20 pound into a share, maybe 100 pound, 200 pound, depending on what company you're going for, then you would just lose the share of that company. You wouldn't lose anything additional to that. But it does not protect against wrongdoing. So anything like wrongful or fraudulent trading, such as what happened with Tesco a couple of years back, or if personal guarantees have been given by directors, it doesn't protect you against that. They could actually say one thing, but it won't mean you are going to get it. Private limited companies. Now these are LTDs. LTD. So if you ever see a company with LTD at the end of it, it means that it is a private limited company. Now, private limited company means that there is a minimum of 2 owners and they are incorporated, right? So it means that they are still considered to be separate entities from the owner, right? But there can be 2 or more owners. Now they've got limited liability, so only responsible for the money invested, and own personal assets cannot be used to pay off business debts. Shares in the company, if you actually wanted to like become a owner in that company, would not be traded on the stock market. What actually needs to happen is you need to go and have a meeting, and it has to be agreed by all shareholders that you can actually buy into that business. And it's usually only small to medium businesses that may be family owned. So there are some larger exceptions like Iceland, Arnold Clark, like B&M. They are all private limited companies, but you know, those are some of the exceptions. And again, we've got advantages and disadvantages. So limited liability, we talked about that. It is very important. You've got greater access to capital because you can sell parts of your business off and people will pay for it. There's more privacy. So again, you do have to publish some like investment and everything, like some of your details, but it's not as much as with public limited companies, which we'll cover next. And there's less pressure from outside investors, and like they won't come along basically and go, right, okay, well, we're just concerned with profit. I want my shares to go up. I want my dividends. Why aren't you doing that? You'll still have some control. But the disadvantages are that it is more difficult to set up than a partnership or a sole trader. So you've got to cover a lot more formalities and administration costs. And while you've got more access to funding, it still isn't necessarily going to be the huge amount of money that a public limited company can provide. And also, with that financial information being put out there, you do actually have your competition able to look at how your figures are going. So public limited companies, now these are the PLCs. So remember, private limited companies are LTDs. Public limited companies are PLCs. Please make a note of that. So they are owned by shareholders with limited liability, same as the limited companies. All right? So anyone can buy shares through stock market and become a part owner. So it means that you don't need to get agreement from someone else in order to buy shares. You can just go out onto the stock market, go through a broker, and you will get them. We'll be covering shares and shareholders in another video. So shareholders are entitled to a share of the profits. However, this amount is decided by the directors and it is called a dividend. And if there has been a particularly profitable year, then the dividends could be quite high. If it's not been so great, then it could be that the directors will actually hold some back for growth or investment elsewhere. You can also use the share price to actually work out the value of a company. So this is called market capitalization. And this is actually a very important method of being able to see the size of a company. So if you take your share price times your number of shares, so please make a note of this, market capitalization equals share price times number of shares, right? Then you will be able to see how much the company is actually worth on the stock market. And a lot of companies are monitored by this. And usually if you see in the news that they say, oh, a company is worth X amount of money, then it will be through this method. And they are usually pretty big, well-established companies. And they find it very easy to raise the money because they can just get more shares. So Amazon were putting a lot more into their space travel. Well, what did they do? They just allowed more shares of their company, $1 billion more shares, $1 billion worth more shares. People bought it and they had an extra $1 billion that they could use in that company. So benefits, limited liability, so it protects the shareholders. No one's going to come knocking on your door trying to get the money that's owed. There's even greater access to capital, so you can sell the shares, you can get more money, and there is much greater power over your supplier because, well, who's going to turn you down if you say you're not going to buy 1 million items off someone or units off someone just because they put the price up? Well, they'll drive that price down pretty quick. Disadvantages though, you've got to publish a great amount of financial data, and this could be a real issue for some companies, especially if you're in fierce competition. Also, in order to have control of the company, you must own 51% of the shares. The person with the most shares, think of a share as a vote. And if you've got a decision to be made and you own 51% of the vote, then it means that you're probably going to get your way. And it is very possible to lose control of the business that you actually started. So you need to be really careful about whether you are going to float a company or not. And then you've got pressure from investors because they may be just concerned about short-term profit. Well, then they're going to be pushing you for all short-term answers instead of long-term performance. They might not be interested in a company that they're just going to sell shares to in the next few months anyway. There are, of course, other types of organization. We've got public sector companies. These are owned by the government or local authorities like the BBC, the police, NHS, fire service. Do not confuse these with the public limited, right? Public sector, public limited, two different things. Please make a note of that. And also we've got not-for-profit organizations. So charities can be large, well-funded, right? You know, Red Cross or cancer research, or they could be small trusts such as the Bright Futures Educational Trust or the Co-op Academy Trust. And of course, then we've got the mutuals as well. So it's like the cooperatives. So these are private companies whose ownership is based off members. So you can become a member of John Lewis or the co-op, and then you will actually be able to like have some vote in it, and there's some direction with the company that you'll have control over. Okay, thanks very much for watching and listening. I hope that that's really helped you with your notes. If there is any question that you've got and you'd like an answer to, then please leave something in the comments below. I will be checking them. Alternatively, if you're using this for classwork, then make a note that you can ask the teacher and they'll be able to actually inform you. If there's any contradiction, of course, let me know as well so that I can correct it. For more information, just make sure, like I said, that we actually hit the thumbs up button and the subscribe button, turn on those notifications, and video 3 will be following shortly.